Yes, I am wearing a Buffalo Bills shirt for you today, but I got a question for you. What happens when you want to retire, but the market is in the toilet? Now, you might say, okay, things will get better. I'll retire this year, but just be frugal and wait until markets bounce back to spend more. Or maybe you think, hey, I'll throw caution to the wind, spend like I normally would because markets do come back, right? I mean, that's what you're always telling us, right, Kate? Well, here's the truth. Poor market conditions during the early years of retirement can cause long-lasting harm. And that's because new retirees are withdrawing money while the market's low, reducing the potential for portfolio growth in the following years. So basically, you're cashing out stocks that are worth less than they were a year ago, and you have less money to work with in retirement. And as a double whammy, your stocks have a big mountain to climb just to get back to even, never mind to start being profitable for you again. There's a name for this phenomenon. It's called sequence of returns risk. Market declines are a reality of investing, but sometimes it doesn't feel that way because we've been really spoiled over the past many years, right? But to withstand poor markets, investors have to be cognizant of their withdrawal rates. Maintaining a balanced stock and bond portfolio and keeping a year's worth of expenses in cash can often help investors avoid the trap of cashing out during a market decline. Now, this is not a fun thing to think about, but you might want to wait out a decline or a recession before retiring. Just saying. I've actually had clients who did that. It's not ideal, but you'll be happier in the long run. Now, there are other steps you can take. For example, organizing your assets into buckets of money earmarked for withdrawal at different stages of retirement. This allows you to designate some parts of your portfolio as conservative, others as more aggressive. And the conservative buckets you would set aside to cover living expenses for the next few years, while the more aggressive part offers you exposure to riskier growth assets, also known as stocks. Annuities have a bad rep, undeserved among TV and radio commentators who don't really understand them, but these can also give you a way to protect your principal from poorly timed market declines. Now, finally, I'd recommend you limit your single stock speculation into a bucket labeled fun money, okay? Hope you found that helpful today. Let me know if there's anything I can do to help you make your money last. Go Bills!